Hi, everyone. My name is Phil Sherman. I'm a certified financial planner and retirement plan advisor here at Deschutes Investment Consulting. And today I'm extremely excited to announce that I'm joined by our key guest speaker, Katherine Kroll of Brown Advisory Group. And today we're going to be having a deep dive on ESG investing. Hopefully we'll learn a little bit more about Brown's role in this space, talk a little bit about their fund, some of the changes that have occurred in ESG investing over the last 5 years and beyond, talk about some of the exciting changes that may be in store for us in the road. And then obviously we want to also make this a more educational and informative discussion. So we're going to ask some of those tough questions around some of the myths and misconceptions around ESG investing and hear it straight from the source's mouth. So as I mentioned, I'm excited to introduce our guest here today, Katherine Kroll. She is an investment specialist at Brown Advisory. Katherine, at this time, I would love it if you could do a little bit of an introduction about yourself and Brown Advisory and your firm's role in ESG investing.
Yeah, absolutely. And thanks so much for the opportunity to talk about this subject. It is perhaps unsurprisingly one of my favorites to dig into because I think it's just so mission critical now more than ever, especially in the last 2-3 years, to find some of those overlaps in ESG and just good investing. So I'm looking forward to our conversation. I joined Brown Advisory about 4 years ago. I started on our ESG research team and have played different roles at the company. Brown Advisory's history is quite a long one. We grew out of Alex Brown, hence the name. We're a private company. Every colleague at the firm has equity in the firm, which I think really helps align us with our clients, with each other, which we'll get into later, but I think it's a really good example where governance structures help to enforce best in class ESG principles. ESG, sustainable investing, lots of different terminology, right? But that's been part of Brown Advisory's history for a while. And I'd say the formalization of ESG, because if you go back 10, 15 years, it was kind of a vacuum. I think this timeline on the screen indicates how much has happened so quickly. But really where we started to get serious and get formal with codifying our ESG attempts was with the launch of a strategy, large cap sustainable growth, over 13 years ago now. And that effort in trying to find fundamentally strong companies that use ESG characteristics to just be better has been at the heart of our approach to sustainable investing. And now you find it, fast forward a couple years, across our entire equity platform, across our fixed income platform, and across our private client channel as well. It's a key priority of our culture, of our business, and we know it matters to our clients. So that's what brings us to work each day.
Thank you so much for that deep dive, Katherine. Appreciate the background information. And for those of you who may be joining this call, listening into the recording here, if you're a current client or a participant in one of our retirement plans that has ESG option available, you may recognize that Brown large cap fund that Katherine spoke about, which is why we're so excited to have them here to provide that additional insight. Katherine, I'm also hoping that maybe you can talk a little bit about ESG and really just sort of the idea of ESG, sustainable investing, socially responsible investing. There's so many sort of names out there that we hear, different terminology, and it's really sort of changed a lot over the years. So can you kind of level set for someone who may be coming in and is interested in the subject, but maybe doesn't have a strong background?
The terminology can be really confusing. There's no shortage of acronyms. It can feel a little bit like alphabet soup at times. There's some rhyme or reason to it from my perspective. Again, I'm looking at this timeline. If you think about the beginning of it, really that started as socially responsible investing, or SRI, that was aligned with faith-based investors, and frankly, long before the 1960s even, that were seeking to put their money where their faith was. And that required a lot of exclusionary practices, which I think is still sometimes the only way that ESG is viewed through that lens of what can't you own. But that was a moment in time. And while we still see some of that trickle through what is now a very busy space, it's more reflective of, I'd say, a subset of approach to ESG. Fast forward and terminology like sustainable investing comes online, impact investing, which tends to, not exclusively, but refer more to investments that are comfortable sacrificing on profit, that will pick one or the other. Whereas ESG, environmental social governance integration, largely today, and certainly from the perspective of Brown Advisory, is one that seeks to look at fundamental drivers of performance through the lens of things that we think align with common sense. Better, cheaper, cleaner, greener. Call it lean manufacturing, call it paying attention to many of the macro conditions that ultimately impact the landscape in which the companies we invest in operate. Whatever you call it, our belief is that looking at how a company treats its people, how a company treats its community, how a company is able to have control over its supply chain, which we see very much connected to things like environmental practices, climate change, et cetera. That's just more information, and more information when looked at through a consistent philosophy and process, we think gives us and other investors a competitive advantage. So here we are today in a space that's so much louder, so much busier than it was certainly when we started, and multiples more than in the 1960s. And with that comes huge opportunity. We're up against big challenges. We know the markets are trying us right now, so will again have before. This is one way to cut through that noise, those challenges, and hopefully find opportunities that align with client interest. The last thing I'll say, though, is there is no one definition. And this is probably a cliche you will have heard if you've listened to anyone talk about ESG before. ESG means different things to different people. And our job is not to try to tell clients what their values are, what ESG needs to mean to them. Because what we often find is that when we sit down with folks, what we hear is not those acronyms, not those specific terminology buzzwords, but still content that's aligned with our approach. So as always, it's a listening game where we try to keep our projections to a minimum and stay focused on process.
I would have to strongly agree with your last comment there. In being here in the Pacific Northwest and having some of these funds available in retirement plans, I meet with very different individuals, diverse groups, diverse backgrounds. And I think you nailed it when you said that ESG means something different to everyone. And it doesn't mean that it's right or wrong. And it also, I think, is important from an investor standpoint to reiterate the point of, this is why it's really important to do your homework on the fund company and to understand the positions that they've taken, the various companies that they've invested in. And so while ESG, I think, is growing in popularity, I think we've seen that with heavy cash flows into these types of ESG funds. When you sort of peel back the layers on what the funds are you're investing in, I think sometimes I talk to participants or investors who have a strong feeling one way or another about a certain company, and may be surprised to see that it can show up in a fund like this. So thanks so much for the additional context there. One last little piece on this sort of topic. I think it's also good to maybe provide a little bit of background how ESG is viewed in the US as compared to more of a global standpoint. And I think a good reason to point that out is, here domestically, we have big players in the space. CalPERS, for example, our neighbors to the south, control a lot of money, and they are taking an ESG lens on those investments. And I know that in Washington, there's a little bit of pushback on some of those approaches. We've obviously had a lot of challenges with DOL rulings on whether or not these are suitable or not. But then you look at a bigger picture viewpoint, more of a global landscape, and we have the Paris Climate Agreement. We have the EU's stance on it and some of the requirements that they make funds or pension companies disclose there, and even some of the UN, which has established sustainable development goals to try to create, a better world within this decade. So I kind of set that up there. Can you talk a little bit maybe about some of the differences domestically versus globally in this space?
I'll do my best. It's a really hard question because I think 3, 4, 5 years ago, it was a bit more bifurcated. It was Europe against everyone else, really leading the way on ESG, at least when it came to an institutional perspective. And now that there is so much demand and interest in ESG, which I think is in part related to what we just talked about, right? That it means different things to different people. There's a permission given to those who might not normally seem like typical ESG clients, who now see, hey, this is connected to the way I think about investment. And just like there is no narrow approach to investment, ESG isn't this monolithic concept where you can talk about anything in absolute. So I do think that element of growth has made categorizing regional approaches even more challenging. What I'll say is that element of cultural relativism comes into play on the issues that we see being prioritized in those different landscapes, and the urgency to provide accountability mechanisms that ensure marketing is matched up with actual investment decisions. So on the first point, in terms of issue focus, I think we've seen out of Europe a real emphasis on the E in ESG. They've led the way on climate, on energy usage, on renewable energy procurement, on ensuring supply chains are aligned with some of the goals and agreements you just mentioned. Mm-hmm. Whereas that's certainly the case in the US in some areas, but we also see an emphasis on the S, on social. And I think that's reflective of our demographic makeup, right? We have more diversity in many ways. We're more outspoken on certain elements like racial justice in the United States. And how can we have our portfolios aligned with those considerations? And then you zoom out even more and you look at the opportunities in emerging markets, where all of a sudden that clean-based approach that we've seen really come out of Europe, where screen out all traditional energy companies, generalization, of course, there's some nuance, but that doesn't look the same in emerging markets. And perhaps that's not ESG to set up new players with the standards that helped get many of the countries where they are today. So it just requires this case-by-case approach, which we're lucky to benefit from, given we build portfolios from the bottom up. But at the end of the day, it just goes back to, it means different things to different people. Different areas are approaching it differently. But where I do think we're all coming on board, this kind of common meeting place, is around climate. And that's something I think we can continue to expect to see.
It sounds like the only thing certain is there's a lot of uncertainty. And I'm sure that I know some of the questions and pushback that we sometimes get is around maybe some of the lack of standardization. And again, I would sometimes encourage participants or investors who are considering ESG to maybe think of that as a positive and not so much as a negative. Remember, as standardization improves and we get better results on tracking some of the measurements of how we define ESG and all of those pieces, it'll be helpful. But remember, it may also force some funds or countries or companies to have to be pigeonholed a little bit into specific requirements that they're trying to check to get points, if you will, to pass certain scores. So in the earlier stages, it may feel a little bit like the Wild West in the ESG space. And I think Catherine's comments kind of showed that there's a lot of changes that are occurring, but it may also provide some opportunities for you to better customize an ESG solution that matches your intrinsic values. So we have a lot of ESG myths and criticisms that are out there. Again, we're here in the Pacific Northwest. I believe just last month, there was an interesting article in one of the local publications that came out where a local professor sort of criticized some of the ESG components. I know a couple of our clients sent it to us to get our own feedback on it. But I think it's important to maybe level set. And I'm going to steal one of the little comments that you made earlier about Brown's approach to how they build their ESG funds. I think that you said you start from a bottom-up approach. And I know that here at Deschutes, when we evaluate our ESG strategies, they have to go through our normal investment screening process. So nobody gets a pass because you claim to be an ESG fund. So for those who are curious as to how we at the advisor level do it, the ESG screen that we put on an investment fund that we're contemplating using or do use is the last screen that we go through in our process. Can you talk a little bit about how Brown approaches it? Because I know that some of the companies that are in your large cap portfolio, for example, may some folks who are focused on ESG may be scratching their head and saying, well, how did a company like that wind up in the portfolio? So I think it'd be really helpful if you could help us understand your process.
Yeah, absolutely. I would say when this fund was launched, almost 13 years ago now, it started as a challenge to the portfolio managers, Karina Funk and David Powell. Can you make money using ESG? And the answer so far has been yes. And we've seen that play out with a number of our other strategies, with many of our peers, and now in strategies across the world, which is exciting. But, and I said this already, I just think it's worth reinforcing. You can't talk about any strategy when you're talking about investments in general as a silver bullet. It doesn't exist. If it did, there wouldn't be so much competition in this space. This is just one way that we think we're able to find more interesting investment opportunities that are likely to help us outperform our peers and our benchmark, because there's something differentiated in them that the stock price might not be reflecting. I think that is the mission that most managers are up against. How can you find something interesting about this company that isn't already being captured? And the way we look at it is to say, we're never going to be able to agree in entirety with our $17 billion worth of AUM of clients in this strategy about what a good or bad value is. That value-based approach to ESG is largely out of our hands. What is in our hands is linking ESG data, whether it be the approach to resource efficiency or retention of talent that might look different from one another, to financial indicators that are part of our investment philosophy. And for us, that means finding ESG that's tied to revenue growth, so products or services that are helping to solve for environmental or social challenges, to cost improvements, companies who are good stewards of their own resources, or enhance franchise value, companies whose link to sustainability helps drive customers to their brand, that creates brand equity and helps them have a stronger corporate culture. And whether you call that ESG or SI or impact investing or just investing, that doesn't matter much, right, at a very high level. And it's why about half of our clients use us exclusively as a large cap growth placement. They care less about how we get there and more where we end up. And that, I think, is an important distinction when looking at the inputs of an investment process versus the outputs. And that input piece is why you might see a company like an Amazon in our portfolio. It's the company that I certainly get the most pushback on. Why is a company like Amazon, with some of the controversies it has to its name in the portfolio? That's easy for me to explain to you because we have a consistent philosophy and process. AWS is 4 times more efficient than its peers when it comes to cloud computing. Cloud computing has almost single-handedly helped keep our digital emissions within our economy to 2% in a time where we know our digital use case is just absolutely accelerating. So that's how we focus on the opportunities. And then from a risk perspective, it's our belief that some of those risks are able to be managed. So they're not severe enough that they require us to pass on the name, but they are extreme enough that they allow us to engage with them. And through that engagement, we think we're able to help move the needle on risk performance on issues like labor, AI, DE&I, and other acronyms of those sorts. So a long way of saying we take a performance first view, knowing that many of the values are out of our control.
Oh, I really appreciate that deep dive. And I am a little glad that you kind of cherry picked and picked on Amazon there, because it is also one of the companies that I oftentimes get pushback or questions, and rightfully so, from investors in the fund asking, how can you do this? How can you warrant this? And again, I think it's another great example of companies drive change in different ways. And it's very difficult for us as investors to completely control all of that. And again, this is why it's a unique space. And for each person, it's going to be difficult for any one fund to completely 100% match up with what's important to your intrinsic values. And so again, this is my cautionary reminder and advice to anybody who's interested in investing in this space is ask yourself those hard questions. They're there for a reason, and it's okay if one fund doesn't match it. But I would encourage you to ask around and research as to why they do, because oftentimes we don't understand everything that a company does and what the full impact is. Same sort of space like when we talk about energy companies, right? So year to date, a lot of the ESG funds are lagging the overall market. I'll use the S&P 500 as the proxy, and some of that's because they've completely screened out energy companies. But I know that we have researched funds in the past that have exposure to energy companies, and they're actually doing a lot of good work in driving renewables and exploring biofuels and other processes that could get us off of fossil fuels. So again, my main point on asking that question was it's really important to ask these questions and to get to the heart of the matter with the funds that you're interested in. So I've got one more sort of tough question for you on this that I'd love to get your feedback on, which is there's a lot of vocal critics out there of ESG investing. I'll pick on one guy, Tariq Fancy, who was the former BlackRock Sustainable Investing CIO. I think he wrote this big 3-part essay sort of condemning the ESG space, and he had a number of reasons. And I would suggest to anybody it's a good read, especially if you want to challenge your own self on your own beliefs around this. And they're good questions that you should ask yourself. But one of the things that I think he did make a good point around is some of the lack of the standardization in ESG ratings. And it is, like we talked about earlier, a little bit of the Wild West out there, but we're making progress in it. And so I don't want to focus too much on the lack of standardization. What I want to talk more about and get your input on is there are some ESG rating services out there, and how, as an investor, can I use that data to help me make better informed decisions? And where do you think that space is maybe going as this ESG sort of develops into a more respected and standardized part of investing?
It's a really good question, and I'll get there in 1 second, but I want to go back to your comment around many of the ESG funds lagging because of their underexposure to energy, because I think it's a really good example of where we sometimes lose nuance. There are many of our peers that are not ESG, that are just large cap growth funds that have intentionally avoided energy for no reason that is related to traditional or modern views on whether or not ESG is good, bad, or neutral. They simply don't like the fundamental characteristics. They don't think it's something they can depend on, that these are companies that don't have a lot of control over their own destiny, that they're not always the most durable or mission critical. And so it isn't just ESG funds that have seen an underexposure to energy. By and large, many growth-oriented strategies are moving away from some of these trends and that have historically served or benefited performance. And that, I think, is where we start to unlock or collapse, at least, the idea that they're living in two different universes, ESG and, traditional strategies, when in reality, they're getting closer and closer together, and it's simply a matter of investment philosophy. So that's just my view, but I think it's one of those opportunities to dig in deeper and do as you put it so eloquently. Where can we have these conversations and ask follow-up questions to make sure we're on the same page? When it comes to rating agencies, to bridge from from that kind of focus on how can we have conversations around issues that might be understood differently. I think there's a lot of misconceptions about them that fall into, as like many things, severe polarized camps. There are plenty of folks that say, forget ESG ratings. They're so disconnected from one another. The rating agencies can't even agree with each other. Why should we agree with them? To we need ESG ratings. Otherwise, as the article you mentioned points out, there is no accountability. It's all greenwashing. There's no way to really measure it. And I think that someplace in the middle is probably where the truth lies. You pointed out at the beginning of this conversation that sometimes a lack of consensus gives investors an opportunity to find unique names. And what we use an MSCI for, who I think is probably the premier leader in ESG ratings, is a very certain piece of input to our process. They're fantastic at capturing controversies in real time. They do a really good job at looking backwards at a company's risk profile. They're in conversation with other stakeholders that influence a company. And that's good data to have, just like a 10K is good data to have, just like a conversation with management is good data to have. And then when you take all of that and you put it through your own lens of philosophy, that's where it starts to get more interesting. So I'd say looking at it alone as a silo, it's just not a replacement for adding it to a process that aligns with your long-term investment objectives. But I'd love to hear your perspective on them. I think you have a lot of good thoughts there too.
Yeah, I agree with a lot of what you're saying. And we sort of live in this gray world right now, and we're doing the best we can with the data and the regulations that we have. And I think another important distinction that maybe most investors don't realize is there's no requirement for companies to go through some of these disclosure processes. So I understand how there could be a fundamental lack of confidence in some of the material that goes into these various ratings, whether it's Morningstar, MSCI, whoever it is out there. So I think from our perspective, it's more information is better. Asking the hard questions of the fund companies and the companies that they're invested in is a good place to start as well. A lot of them are realizing that this is important to investors. And so I think over time, what we're starting to see play out in real world is companies are being more proactive on this. My wife is in the accounting world. She's an auditor. She doesn't do tax. Don't worry, I won't bore anybody with tax talk here. But I know that the SASB, for example, so the Sustainable Accountability Standards, right? So that is a growing space in the accounting world, and it is becoming more and more popular, and they're doing better and better research and disclosure on these pieces. So I think from our stances, the more information we can get, the better. I'm a big fan of bouncing around between a couple of the rating systems, because again, they're focused on different things, and your intrinsic values might match up better with what Morningstar is tracking as opposed to what MSCI is, for example. So again, I wouldn't let the lack of rigid standardization in this space be a deterrent. Again, look at this as an opportunity to do a deeper dive for what's important to you. And I think that's a good way for us to wrap up here and talk a little bit about where's the future of ESG investing headed. So obviously it could be with increased standardization. We're seeing heavy inflows of dollars. I think a lot of what happened during 2020 and COVID, and then everything else that played out that summer around racial inequality in the US specifically, drove a big additional encouragement and I think excitement in this space. But I'd love to hear it from you and your perspective and your team at Brown as to where you think this space is headed.
I love your comments prior to this question, and I'd borrow from them. It's interesting. I think one of our from my views, one of our secret weapons is Victoria Vera. She's an ESG analyst that covers technology. Her background is that of an accountant. So maybe she and your wife can be in touch. She helps lead our working group activity in SASB, the consortium you mentioned. And I think it is a proof point in this idea that the worlds that previously were separated or sometimes pinned against each other are working with each other to produce better outcomes for clients, whether that be performance or whether that be living conditions, whether that be value alignment, or whether it be some combination of all three. That is where I think we're moving. And it's interesting because we talked a lot about how busy this space has become and how there is a lot of dispersion among different stakeholders. But if you go back to when at least this strategy was launched, it was the same problem, but for the opposite reason. It was crickets, more or less. It was harder to get people excited about an ESG opportunity. And now you see people using ESG to get those opportunities.
Yep.
And so I think there's a lot of lessons to be learned from those first movers who had to make sense of a world without rules or standardization efforts, now that they sit in a very different world where there's no shortage of those efforts. At the bottom of it all, I think, is there will always be nuance. It will always be part art, part science. We do need to create a floor, which I think, you know, some of the groups you mentioned are working in collaboration to do. And once that floor is established, all of the other approaches to ESG, from my perspective, can live in harmony with one another, so long as they're underpinned by the basic preferences in good fundamental investing that make them relevant.
Oh, I appreciate that. Yeah, and I think you're right. There's more to be discovered, and it is nice to sort of see some of these factors working together. I also enjoyed your little comment about using ESG as a marketing piece too. And I would just remind everybody who's out there listening to this call, remember, fund companies can pick the name of their fund at a whim, right? So read the prospectus. Don't just read the ticker symbol or the fund name, right? So again, this is all about making sure that you take the time to educate yourself. And I hope that today, and thanks to Katherine and her team for making some time available to us, that you were able to do that. I know we didn't get all of the answers that maybe you specifically were looking for, but hopefully it at least gave you a good foundation to build off of as you explore this space yourself. Katherine, I'd be remiss if I didn't give you a chance to just say, if anybody enjoyed some of the comments that you had or wants to learn more about Brown and some of the work they're doing, where can they go to get some of that information from you and your team?
Yeah, please don't hesitate to reach out to either of my colleagues. Probably your point of contact would be Stephanie, that we're happy to put you in touch with. And our website has perhaps too much information on it, but if you're looking for thought leadership on any of the issues we touched on, hopefully that will be a good home for you.
Great. And for those who are listening, I'll be sure to make some of these links available in our little description that we do for a write-up here. And yes, I've played around on the website before. There's countless white papers on the subject, and a lot of them addressing some of these tough questions. Getting in front of the questions of, am I going to be sacrificing returns? What about some of the lack of the standardization in the space? And they also did a really great job of doing write-ups on the specific companies. And so if you do have a question around why is a company like Amazon, for example, a part of this, I will say that Brown doesn't really try to hide anything, right? So they're going to have to explain this themselves, and they have all of that information available on their website. So if you're excited about this, interested in learning more, it's definitely worth a few minutes out of your day to go play around and read up on this. So Katherine, again, thank you so very much. And for the rest of your team at Brown Advisory, we've enjoyed working together over the years, and I've appreciated the benefits of having the access to your fund for both our individual investors and our retirement plan participants. And again, everybody who was listening in today, I want to thank you all for your time. I really hope that this was educational and informative. I know we didn't get to every question that everyone out there may have. So if you need more of an in-depth discussion around this, reach out to our team here at Deschutes. If it's something that we can't personally handle, thankfully we have experts like Katherine who are happy to help us out to get to the meat of the heart of your issues. So thanks everybody for tuning in. don't forget to check out our little write-up here for any of the resources that we discussed on the call.